I want to make a couple comments about double leverage on the electronically traded funds. You can sometimes get funds on various commodities like silver, gold, oil, that they'll move, 200% twice, basically, what the movement is on a daily basis before fees and expenses of the basic commodity that they're following. So like this one here, Pro Shares Ultra Silver AGQ will move twice. I saw something from a very good presenter of silver videos. There was something, it was just kind of, I don't know, maybe it was, I'm sure he knows, but it was just a little error. When it goes up, for instance, up 20% and down 20%, if you just follow these calculations, it would erode like crazy. But that is not exactly how it works. It works, I don't want to get into too much detail on this, but it's actually a simple mathematical formula. So for instance, in this, you're moving up, say 5%. On this one, you move up 10%. And say, for instance, here, you're moving up on this line, you're moving up 10%, you're moving up 20% on AGQ. It does erode over a period of time, but it's not as dramatic as you think. Like, for instance, these are some pretty big moves, 5%, 10%, then down 5%, up 6%. So you can see it eroded down here, okay? It doesn't erode as bad as you think, and the fees are, pretty reasonable. Like this is a fee here, 0.95%, less than 1% a year, and the average is 0.85% for these type of funds. It's not really the big super rip-off you think. It is kind of dangerous though, because if a commodity goes down, you can really lose. And the fund does erode a little bit over a period of time. And if something goes up double, you're not going to get 4 times, because but it's not that bad. I don't want to make it, I don't think it's a great thing to do too much of, but I would I would think it's not a bad thing to do versus like options and futures where you can be 100% in or 100% out. If you see this radical pullback in silver and you want to put a little bit of money into this, it's not a bad thing, really. I'm not saying this really as financial advice because I don't trust the paper markets much either, to tell you the truth. But reality is, whenever I see money, I see it in paper or I see it in electrons, and when I have to pay money out, that's how I pay it too. So I think the physical holdings are smart, but they're more a little bit of a long term. But give you an example, like for instance, say silver was 40 bucks and it went up to 65, 45 or whatever. So that's 164% gain. Now this leverage AGQ wouldn't be at 40, wouldn't be starting at 42, but the percentage gain would be 261% using this example. And this is all upticks, no downticks. So instead of going up, 328%, it went up 261%. So similarly, if it goes up double, you're going to get more than 3 times. You're not going to get 4 times. And that depends on how long a period this goes on for. But it's not like an extreme rip-off or anything. It does erode, but it's not too terrible. I just want to point that out. The paper markets, I don't know, if there's a real crisis, there could be a problem. We saw what happened with the brokerage house, MF Global, where the cash portion of the brokerage accounts, I don't know if they're SOL or what, but that could be a problem for people. This was an article. I know this is relating to oil, but everything in the commodity world, there is some type of relationship. It's not like a one-to-one, but in general macroeconomics, when there's fears going on in the currencies, people are looking for safe havens other than government-backed bonds or bank or corporation-backed bonds. A lot of times they go into commodities. But they're talking about oil in this instance, and they're saying prices could spike by a third to be above their all-time high of $147 a barrel. It's probably going to go to like 160 or more. I don't know when that's going to happen. They're talking in the near term. I'm thinking right now, when we're looking at these prices going up, it was like over 97 a barrel, I think, last night. When you're looking at the metals are, they're not doing so super good, except maybe gold. And I think gold is going to do fine because of uncertainty. That's kind of more of a traditional investment. But also, crude oil is a big, big, big market, and it's also an investment that more investors are more familiar with, other than some of the other metals, even including silver. But I think silver is possibly going to explode at one point in time. But it is related to this article, even though it's on oil, because oil, like I said, is very much related to the operating cost of mining. And right now, there is more and more of a physical shortage of these precious metals, and they're just not going to jump out of ground. Now, you figure if oil spikes to $147 or $150 a barrel, 40 to 50% of the operating cost, from what I saw, of a mine is diesel fuel. So what happens if you need to get more production going? It's going to cost twice as much. They've already been having a drawdown of silver stockpiles, because the world demand has exceeded the output by, I think it was 135 million ounces, I believe that, or 150 million ounces. I believe it was 150 million ounces, or just over that, to 155 million ounces. So there isn't all this silver all over the place that people can buy. So to produce more, it requires a hell of a lot of energy. So what's going to happen? It's all interrelated. This looks like this isn't even over, the possibility of an attack or strike on Iran. Now, if there's an attack on Iran, oil is going to go over $200 a barrel. I mean, they're just talking about production, and right now the production is not up there. That's what I was kind of wondering, because the Libyan oil has been coming on pretty strong, coming back pretty strong, but it's still far short of where it was. And Saudi Arabia is actually peaked in oil production. So you're going to see more, the prices escalate for this reason. They're saying that OPEC and the International Energy Agency hit lows in relationships earlier this year, when OPEC failed to agree on an increase in oil output, and the International Energy Agency released its stockpiles to compensate for the loss of Libyan oil. I think OPEC, in other words, you're talking primarily Saudi, they can increase it. They can. I think they're at their limit already. They're talking like they can, but I don't think they can. So there's going to be a spike in oil prices just due to stuff coming up a little short. So add that to some other fears that Europe is not going to be investing as much in the Middle East and North Africa because they don't have the money, and the fact that investors are looking for a home for money that are, other than bonds or just holding in cash or whatever. If they even pour into the oil versus just the gold, it's going to drive up all the precious metals a great deal, because, as I repeated before, 40 to 50% of the operating cost is diesel fuel. And if the stockpiles are coming on low, they're going to have to get new stuff, and the new stuff is going to be that much more costly. They're just not going to get it. People are not going to mine for a loss for, it's going to be a matter, especially when there's going to be a demand there, and there is going to be a demand there. So what I'm saying is, this, even though this is an article about oil, as it relates to the landscape right now in the world in economics, it's probably going to bring about a major spike in silver, gold, platinum, and palladium, or else they're just not going to get the stuff out of the ground.